We just got deflation for the first time since 2020. And yes, I mean deflation, not disinflation. And this is also going to have an impact on your portfolio. This chart right here is a chart of month over month price changes. So anytime you have one of these blue bars above the zero line with a positive number, that's how much prices changed on average from 1 month to the next. For instance, in January of this year, prices increased 0.5% from the month prior. You can see the last time this number was negative was in 2020. March of 2020, prices fell 0.5% from February to March. And then April of 2020, prices fell 0.8% from March to April. And then May of 2020, prices fell 0.1% from April to May of 2020. Since then, we have had a few months where the CPI registered zero change in prices, but March of 2025 was the first month where we have had price decreases. This is different than disinflation. Disinflation is prices still going up, but they're just going up at a slower pace. That'd almost be like if you're driving a car and you hit the brakes. You would be slowing down, but you're still moving forward. This would be like throwing the car in reverse and backing up a little bit. So right now, from February to March of 2025, on average, prices actually went down. Now, obviously, prices going down 0.1% is not really meaningful, especially considering the fact that things that people still care about buying are increasing in prices, like eggs. So why is this a big deal? Well, inflation numbers are one of the most important things that the Federal Reserve pays attention to when determining interest rates. When combating the inflation they unleashed from the trillions in printing in 2020, they raised rates extremely quickly and then held them steady through basically half of 2023 and all of 2024. Towards the end of 24, they did start to lower rates, but because that caused a resurgence in inflation and it caused interest rates on longer term bonds to actually go up in response to that expected inflation, they decided to stop lowering rates and hold steady for most of 2025. Now, year over year inflation is still positive. When you measure prices from March of 2024 until March of 2025, prices did still increase about 2.4%. But interestingly, that's the exact same place that the CPI was at in September of 2024, which is right when the Federal Reserve started cutting rates last time. Again, the CPI is one of the main things the Fed pays attention to when determining what to do with interest rates. And with year over year inflation back into a zone that they like and looking like it's headed lower, and month over month inflation actually negative for the first time since 2020, this means that the Federal Reserve does not have the excuse that they've had for at least the last couple of months to hold interest rates steady, especially if you start seeing problems appear in the job market, if you see problems appear in the stock market, if you see problems appear in the bond market, if you see numbers going the wrong way with GDP. Any of these potential catalysts, people could be looking at the Fed and saying, hey, you should be lowering interest rates. And with the inflation numbers looking the way they're looking right now, they will not have the excuse to say, we can't lower rates because inflation is just too high. Now, we're already starting to see cracks appear in the bond market. I made a video about this already. Go back and watch it if you haven't. But the 10-year US Treasury yield has been skyrocketing recently because of liquidity problems, an unwind in the basis trade, and hedge funds getting liquidated. This lack of liquidity would be solved by the Federal Reserve lowering the federal funds rate. We've also very obviously been seeing cracks appear in the stock market with wild swings in stock market prices that rival some of the biggest crashes in history, like the Great Depression. And the Federal Reserve lowering interest rates here would be very bullish for asset prices. If we go back in time a bit to 2018, the stock market was crashing towards the end of 2018 when the Federal Reserve was tightening. President Trump put a ton of pressure on the Fed, and because the inflation numbers weren't there, they didn't have any excuse to keep on tightening. So they reversed course, started easing, and that sent the stock market soaring again. You can see here, the federal funds rate right at the end of 2018 was when they stopped raising interest rates. And so with all of the risks popping up everywhere in the stock market, the bond market, the real estate market, trade war, GDP, and now the main reason the Fed tightens suddenly starting to turn around. It seems like it is only a matter of time before the Federal Reserve starts easing again, lowering interest rates, which would be very bullish for risk assets like stocks. The stock market is already down more than 20% from top to bottom, which means this is a bear market, and bear markets do not happen very often. And when they do, if you don't take advantage of them by buying the best stocks in the world at discounted prices, you end up kicking yourself for years to come, hoping that you catch the next drawdown. Don't let that be you. And if you don't know what to buy and don't know when to buy it, I've created the perfect bear market investing guide for you. Gives you everything you need to know about how to build your fortune during this bear market. I've got it on a crazy discount for right now only until the bear market is over. So don't wait until it's too late. Linked in the description below. As always, thank you so much for watching. Have a great day.